CrowdStrike has fallen more than 40% since its highs, which it reached about earlier this month, basically just shy of 400. Implied volatility has popped quite a lot. We're going to talk about that and some things that we're seeing on the equity side today on open interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. So one quick point I'm going to make, because you might actually see this. In the event that this camera suddenly moves this way or that, there's a 100-pound dog sleeping underneath it. However, we have backup battery supplies, so I'm hoping that it's not going to knock it out the way she has done on previous live streams. So, as I indicated before, I wanted to talk a little bit about CrowdStrike because something struck me as rather interesting about it. So, back in early July, the beginning of July, before the debacle, the big outage took place, when the stock was trading above $390 a share and was valued, and the company was valued at about $100 billion. 3-month implied volatility was about 40%. Fast forward to today, and the stock's down more than 40%, and 3-month implied volatility is now 50%. So there's a little bit of an academic exercise I want to go through here, because I think it's helpful when we think about things that options prices, sometimes they can tell us a lot, sometimes they don't necessarily, and sometimes I think they might be getting it wrong. And here I think this might be an example of that. What do I mean? So we can take the implied volatility of an option, and let's just talk about this very quickly. So what does volatility mean to an options trader? Most options traders speak vol. They speak volatility. When they think about volatility, they're referring to essentially the price of an option. And the way that is standardized is volatility represents the standard deviation of the underlying asset annualized. So, you need to know the term of the standard deviation that you're talking about so that you can essentially compare options of different tenors. I can say 50 vol, meaning 50% standard deviation 1 year out, but I can relate that to an option that expires in 1 week, 1 month, 1 quarter, 1 year, or even beyond. So when you hear options traders talk about volatility, if they say 40 vol, what they're talking about is the annualized standard deviation for the underlying, in this case CrowdStrike, is 40%. So just less than 70% of the time, it should be within plus or minus 1 standard deviation, 90% of the time 2, and so on. Now, we also often hear people talk about implied moves, or average moves, or expected moves. And I have sometimes heard people say that if the VIX is 16, then the average move on a given day would be expected to be 1%. This is not actually accurate, because the average move, the implied move, actually is referring to, in statistical terms, something called the mean absolute deviation. So how much something moves on average is not the same as 1 standard deviation. As it turns out, it's approximately 0.8% of that number. All of this is going to be relevant with respect to CrowdStrike in just a second. So what that means is that if somebody gives me an annualized volatility number, I can then translate that to how much the market is expecting the value of that underlying asset to move over some period of time. And I can adjust for it. So 90 days is approximately 1 quarter. And you adjust for it like this. So if the annualized number was 40%, and you don't have to remember all this math, it's pretty straightforward, but you can look it up if you want to, but you'll understand the point of all this in a second. $100 billion company, 40% annualized standard deviation over 1 quarter. So I divide 40 by 2, which is basically adjusting from 1 year to 1 quarter. I divide by the square root of time. So there's 4 quarters in a year. So I divide by 2. That gets me to 20%. Multiply that number by 0.8, which is the square root of 2 over pi, Again, don't have to, it's not going to be a quiz or anything like that. And what that means is that on July 1st of this year, the 90-day expected move, change in the value of CrowdStrike over 90 days, over one quarter, was about $16 billion. Now the stock is less than $60 billion. And that number is 50% annualized standard deviation, divided by 2 is 25%. Multiply that by 0.8, multiply that by the current market capitalization of the company, and what do I get? 11.8 billion. So over the course of 1 month, from pre-debacle to post-debacle, the options market used to think that the value of CrowdStrike would change by 16 billion over 90 days. And now it thinks it's going to change by 11.8 billion. Well, that's very strange when you consider that only yesterday it changed by 6 billion, because Delta announced on Friday that they were intending to sue for damages, and they estimated their damages at about $500 million, which, by the way, is half of the net income that CrowdStrike is expected to generate for the full year, which was $990 some odd million, if my memory serves. And this is already a company that's trading at a high valuation. So what am I saying about all of this? Well, a couple of things. One, I'm saying that I think options premiums in CrowdStrike arguably should have gone up a lot more than they did. Not just because of the move we saw yesterday, but because there's a tremendous amount of uncertainty here. There are a lot of potential plaintiffs who take issue with what happened to them as a result of CrowdStrike. Delta is but one of them. Microsoft, which our guest, which I'm going to introduce in just a second, he and I were talking before the show, and I don't think Microsoft is going to pursue CrowdStrike, but if they did, that would be particularly damaging. But there's certainly no shortage of participants, customers, affected parties who might be inclined to do something. So CrowdStrike, boy, I think this one's really in the woods. Coming up with another stock that was really in the woods and that we talked about on this, Weston, which we talked about right after they reported their second extremely disappointing quarter in a row. A couple of things have happened since then. One of the things that happened was McDonald's reported earnings. The results were disappointing, basically declines across the board. Management has fully admitted that consumers are balking at higher prices. Foot traffic is down. They were touting $5 menus essentially as a way to bring people back in, basically talking about real harm to their price mix, which interestingly enough and unsurprisingly is the same story that was being told about Weston. When they reported their earnings, they really talked about a disappointing price mix. Now, I still think that low double digits, that company's valuation creates some margin of safety. But I think this is a good time for us to bring in our guest today, somebody I've known for a very long time, haven't spoken to in quite a while, but happened to read the article that I wrote about Weston. And he happens to have some fairly interesting and unique insights. So our guest today is Jim Seligman. I've known Jim for many, many years. Jim is a former options market maker. He has worked at some big firms. He worked at O'Connor. He worked at Knight Capital. And now he's the president of a company called SPI Stocks. And he's been seeing flow in names like CrowdStrike and Weston. And so with that, I'm going to introduce him right now. So Jim, it's great to see you here. Could you please tell us a little bit about SPI Stocks, what it is you guys do, and why it was that you reached out to me after you read the Weston article?
Sure, Mike. And it's a pleasure to see you face-to-face again. SPI specializes in stocks that are on the short sale restricted list, which is approximately 1.5% of the volume every day. And it consists of stocks that are down 10% during the course of the day, or were down 10% at some point the prior day. So on the day that Weston was down very hard, we saw active sellers from institutions and also from our smaller, more speculative players. So we have a customer mix that varies from persistent day traders, as they're called, to large, well-known Wall Street names, and you can see their activity, see motivation in their activity. And what we allow them to do is hit the bids on these names that are down 10%, which we provide some price improvement. The SSR is SEC Rule 201, which is pretty much the only limitation on short trading, assuming you can get the borrow, and that is, excuse me, that is that you're not allowed to hit the bid, basically short. So you have long stock, there's no restrictions. Once a stock hits the SSR list, you're not allowed to hit the bid. For most of you, if you have a terminal, it'll be white instead of red or green. That's a common way to see it. Lamb Weston, we saw, and I reached out to Mike and told him this, we saw very aggressive order flow from the large institutions, but we also saw reasonably aggressive selling from the spec traders, who frequently are capital constrained and are not playing in a $60 name as aggressively. And if they're not right, they're out of business. So they tend to have you can see the ones that are learning, but the ones that are playing around in $60 names are typically good at this.
If I may, just to follow up on what you just said, so a way to read this, and I think this, your business is an interesting one, because you have a real sort of specialized type of order execution that you handle. But essentially, what you do is you handle the executions for people who are pressing shorts. Is that so? Basically, after a big decline, essentially leaning into a short after a big decline, because a stock would have to be down it has to be down 10% to begin with,
right,
to be on the SSR. So by definition, when you see it, it is a stock that has already been hit and people are still trying to lean short. Is that a good way to read this?
That is typically a good way to read this. There are also, sort of firms that are short the stock, but not necessarily short the return.
Short delta.
So they might be right. They might be option market makers. They might be ETF players. They might have converts on, things like that. And I mean, I don't remember if you remember your option market making days, but most option market makers are short the stock most of the time. And so they might be the long delta and, getting out, or they're trying to complete a basket, or they've been carrying the position as it rallied up in long calls that they haven't had.
Well, interestingly, when I was a market maker, I always tried to get long stock, so I would usually do really big conversions whenever we got a new name. Largely, so there was an exemption at the time, and I asked you this question before, but just basically for everybody else's edification on this topic. In the late 90s, there was an exemption for options market makers, even when there was an uptick or zero uptick rule for shorting stocks on the OTC side. So I'm talking about NASDAQ stocks, but not on the listed side. So New York Stock Exchange listed stock. So right. Whenever we had a New York Stock Exchange listed stock, we would usually convert for good size. And when I'm saying for good size, I remember when we took on Tyco, for example, in the multiple listing days. I became the specialist in Tyco, and the first thing I did was convert 2 million times. So essentially just get long 2 million shares of stock so that I could hit downticks if I needed to. By the way, for those who are interested, Tyco was $110 a share at the time. So that meant that we were carrying a lot of stock. And what that also means, and one of the reasons why market makers probably don't want to carry huge amounts of stock if they don't have to, is that you still have a borrow cost, and I'm just talking about borrowed capital. I'm not talking about borrowing for shorts, but a borrow cost associated with that, which meant that I was essentially short rho, which is the sensitivity for options that's related to the cost of carry. So if rates went up, that would result in a loss. So just the Tyco position alone was about $250 million. So if rates went up, that would be a problem. And in the late 90s, they did. We had 5 consecutive rate increases. I remember that quite painfully. So you were seeing people essentially leaning on the short side in CrowdStrike, and you saw it in Weston. What are you seeing today? What kind of names are showing up on your radar?
Well, obviously CrowdStrike again, very active again with the specs. I don't think we had as much long puking, as I call it, but they were still unloading from there. Two of the more interesting names were, I mean, yeah, there are obvious ones like Interest and Merck, but some of the ones you may not know as well. ADVX. Let me expand this a little. ADVX, which typically does.
So this is
about
Avid Exchange Holdings.
Yep, Avid Exchange Holdings.
I'm going to pull a chart up here in case somebody wants to just show this chart. Now, if you're looking at my chart, by the way, in the upper left-hand corner, so Jim, you were saying that on most people's platforms, if a name is short sale restricted, it's going to show up in white, did you say?
Yeah, that's a frequently used method. It'll show up in white,
yes.
And when you click on it, some sort of warning bar pops up.
Yeah, so in Bloomberg, by the way, so when you guys are looking at my screens, and I'm showing you a Bloomberg screen right now, these are going to be red or green based on the price. The magic indicator that we're looking for that is referring to the short sale, the SSR restriction, is up here in the left. So you're going to see this little S. So whenever you see me pull up a ticker symbol, and actually I probably should have mentioned that once before on these live streams, but I never have until now. It just didn't seem like it was all that important, but I guess it is kind of. So just look whenever I pull up a ticker symbol, if you see this little S up here, that refers to the short sale rule being in effect. So I'm just going to shorten up what we're looking at here. We can take a look at a 1-month price chart for Avid Exchange. And so I happened to look at this earlier today. So I know that the reason why the stock is lower. So they just reported earnings, and they did beat by a couple of cents, but they missed on the revenue side, and more importantly, they guided lower on the revenue side. So missing on revenues and guiding lower, that's kind of a disaster. And what was the other one that you mentioned? Lemonade, I think?
Lemonade. There it is.
Yep. So same thing here, the magic S, if we will, and exact same story. So they also reported gapped lower, gapped lower, guided lower, just an ugly picture. And the other thing we can see here, and this is kind of interesting, let me just pull up an intraday chart because you guys might find this interesting. So and I don't know whether your broker happens to use SPIstocks.com, SPI Stocks. Is it SPIstocks.com? Is that your website?
SPIstocks.com is the website.
Yeah.
SPI Stocks is the, if you put that in Google, we come right up.
Yeah, so SPI Stocks is working with some big retail brokerage platforms. Is that correct?
Not.
Or you're looking to, or you're trying to, or
better would be ProTail.
Yeah, ProTail. So yours is a prosumer product. You have institutional clients and more professional self-directed investors. This is not the kind of thing that the average person on Robinhood would be availing themselves of, because chances are they're not playing in this space. But I bring this up because one of the things you'll notice is that the stock is short sale restricted, and I'm sure you probably can't disclose too much about the flow that you're seeing intraday in the name, but obviously you can see the downtrend in the stock all day. So it basically opened on its highs, which was a big gap lower, by the way. And other than a small bounce that it got between 9:45 and 11, it's basically been trading straight down for the rest of the day. So if you were trying to short this stock, you'd have a heck of a time doing it unless you had access to something like SPI stocks and that kind of thing to help you out.
No,
Okay, so go ahead.
This is the kind of chart our spec users love. Frankly, they see something gap down and then show weakness. They will, sell the rallies and then sell the weakness.
So they really lean into it in this kind of situation.
I would say the two best setups they've had over the last 6 months were when the regional banks were all getting hit. They did very well in those, including a couple that were, taken out after the close. And when GameStop rallied, there were dozens of names, maybe 60 of them, that rallied from, say, a nickel or a quarter to $3. And as soon as GameStop started to break, we got less of the spec flow in GameStop than we expected, but we got a lot more in $3 names that were then breaking down to 240, and then they went at them with both hands. We even saw sellers on 30-cent names because they were going to, they were expecting them down to be down to a nickel in a week, and they were not terrible calls.
That's gutsy. that's gutsy trading right there, I've got to say.
No, it left an impression on me. Like, this is a daring business model, but they did it consistently and made it work.
So I guess the read that I would take from your comments here is that we often will say don't fight the trend. Whether or not you're a long-term fundamental investor, a short seller, it doesn't really matter. Whatever is your driver, just don't fight the trend. And from what you're telling me, that's wise advice. Whether you are trading a long-term trend in a bull market, or you're trading a short-term one in a hard-hit stock. Is that fair?
Yeah, no, it's surprising how much this is about individual names and less about the market. I'm used to being in a world where, if the market goes up, generally being long stuff is a good idea. And this is a different world. This is a world where the individual, earnings season is obviously wonderful for us, but the individual names really make the difference. And as you pointed out earlier, guidance is a trump card. So if they guide lower, I almost put them on the list. I put them on my market watch screen quite early.
Right. So one last thing I think I want to just ask you before you go. Obviously, you have a new lens on the markets now, given what you're doing. And I'm getting one just talking to you, which is really helpful because it isn't an area that I'd really seen before. Obviously, we used to get a lot of flow at Cantor and CRT, so we had some inkling of what the real money accounts were doing. We could look at the pages, see where the size columns were filled, but you get a very specialized kind of flow, so that's kind of interesting. So with your view of the markets right now, I'm going to put you on the spot a little bit. You were an index options trader. I think that's what you were doing at O'Connor. You can confirm this or not. But with your perspective as a longtime options trader, as an options data and flow trader, and now with your current sort of perspective, what are your thoughts about the market going into the end of the year? Do you think it's going to be largely driven by the election? Do you think it's going to be driven by rates? Do you think neither of those things matter that much and it's going to be driven by something else? Are you optimistic or pessimistic? We've had quite a run in the market these last few years, and always curious to hear another seasoned professional's point of view on it.
I am sort of skeptical of valuations, and it's ringing all the sort of classic tropes about, bubblicious and all that. That said, I know people in tech, and there is real money being invested in AI, and the cliche is that, stuff always takes longer than you imagine and is worth more in the long run than you imagine. So the 1 year perspective on it may be tricky, but the 20-year perspective should be very solid. Um, I'm frankly, I'm learning how to best uh, read this new kind of flow, and it's evolving as we add new customers. We're growing rapidly enough that I'm very happy about it, but I'm not fixing on uh, any week's data as a final data point. Um, I do know vols historically are suppressed by a third, which is a significant amount between when the candidates are chosen and the election. I think all those people who are talking about this being unprecedented, about getting a new candidate this late in the year. Um, you see it in the vols. You know, VIX has gone from sub-teens to bid, and I think we are going to see a flow of new information. I think the rates information is really well telegraphed, even better than Bernanke did it. So I doubt there's going to be a lot of sort of rates-based surprises, but the politics-based surprises, it's not abnormal for elections to be decided in the last week.
So, right. So, just as a follow up to that point that you just made, on this live stream a couple of weeks ago, before sort of all hell broke loose, if we can call it that, I had talked about buying some downside protection, first in SPY, and then a couple shows later in the Russell 2000, which was the big Trump trade. So after the debate, the Russell blew up relative to the S&P. I think we had like 9-10% outperformance in mere days. And now vol is higher. The markets are a little bit lower, I think, than they were at the time. VIX at 16. So would you remain a buyer? You think that the surprise is, you think it's fairly valued here to still continue to hold it? Or if you had
I think
bought
it's
those
fairly
hedges, would you
valued.
blow it up?
We did see a lot of rotation after the debate. Hot stocks got crushed again. Uh, Chip stocks did quite well. And solar stocks and EV stocks, ex Tesla, all got destroyed. There was like just 2-3 days of hard selling in all those names. Um, and, when Kamala came in, there was sort of a derotation. And, I think arguably uh, it was better for small banks, which is the Russell outperformance.
Right.
That's what I'm inferring.
Well, Jim, this has really been it's been interesting and helpful. I'm glad that we kind of reconnected on this. Put me on your distribution list. You've got my email. I'm very interested in the flow that you're seeing, and I really hope to get you back on the live stream, and we'll see if we get some questions and the kinds of things that people are interested in. Oh, okay. Yeah, so Corey Henderson says, great session thus far, great intro, great guest. Thanks, Mike. So, Jim, your views and your perspective are welcome. Actually, Joseph Kamen also says, thank you, Jim. So people are interested in what you have to say. I'm interested in what you have to say.
It's been a pleasure. It's been interesting, and I'm happy to come back. As schedules align.
Well, I'm going to have you back a lot. I think I'm going to want to have you back both ahead of and immediately following some big catalysts. And just keep your machines on so you can tell me what you're seeing in real time. I'm sure everybody else is going to like that, as well. So yeah, Jim, it was great to see you, and I'm going to get to taking some of these questions, and we're going to have you back real soon. Thanks for joining us.
A pleasure. Thank you.
Okay, so PC is asking, how do you lean on shorts through options? Options have high vol, put spreads. Excellent question. And actually, PC, I saw that you had an earlier question as well. When implied volatility is greater than historical vol, what do you consider and how do you construct? And actually, I'm going to put that question up first. So when implied volatility is greater than historical vol, what do you consider and how do you construct options trades for stocks with impending earnings? Example, Square. Square, block. So here we are. We're just going to pull this up. Used to be known as Square, but okay. So we have earnings. We'll take a look at this one together, and we'll try to work through it. So if you can see my screen, I'm going to blow this up a little bit, and I kind of want to get a sense of what you guys can see. So I'm going to leave this up for a second so that you guys can actually read it. Okay. So the implied one-day move is just over 11%. And the long-term average historical move is approximately 8%. You can see those over here. Only read a little bit into that. Why do I say this? Because when options traders think about vol, maybe you've heard of things like Garch models, which is a vol forecasting model, and things like that. But generally, we weight more recent events more heavily than longer dated events. So if it's really how volatile a stock is recently, it really is how volatile a stock has been over similar recent catalysts that's going to matter more than how volatile the stock was many years ago. So for example, if we go back to mid-2020, we can see that May 2020, the stock moved 3.5% or something like that on earnings. And we can see a lot of quiet periods earlier. More recently, the most recent quarter, it didn't move that much, 1.2%. Actually, that's an interesting thing, by the way. Just notice this. So as I was looking at 2020, the May, maybe not. Okay. So it's really going to be these most recent quarters that matter more. And what we can see is that 3 of the last 4 quarters, we got double-digit moves. Up 16%, up 10.7, down 13.6, ignoring the most recent quarter. So now let's just take a look at how volatile the stock has been relative to the price of options. So I am going to put 1-month options prices in here, and I'm going to compare that to 1-month realized volatility. And we're going to see how these things align. And what we can see is that right now, implied volatility is substantially higher than recent realized vol. Why is that? It's because it's anticipating the volatility associated with that event. And you can actually, if you're looking at this chart right now, pay attention to what you're seeing. Okay, so this really speaks to this. So white is the price of options, and orange is what the stock actually did. And so you can see that options premiums are fairly consistently bumping up before realized volatility. That's because options are baking volatility into those upcoming events. And we can see how well or not well they managed to do this by comparing how well those things align. And I can actually, I believe I can stagger this. So let me see if I can lag this by a bit. Oops, I went the wrong way. Sorry. I want to go like this. Oh. There. Okay. So now basically what I've done is I have jogged the realized volatility, which obviously took place afterwards, to the implied volatility, what the options markets were expecting before those events took place. And you can sort of see, it might be a little bit hard to make out, but I hope this is helpful. You can see, for example, that implied volatility was very high back in October of 2022, but realized vol actually ended up being even higher. Volatility was very high in February of 2023, but realized vol over here ended up being even higher. Same thing here, not so much here. So October, so late last year, the last quarter-ish, we can see that options prices actually did get significantly overpriced. So had you bought options going into this event, it's not likely that you would have made money unless you happen to really get the direction right. But here, the next quarter, options were very reasonably priced. Next quarter, options were slightly overpriced. But notice where we are right now. So I'm just going to draw a line so we can take a look. And just see, so this white line represents, well, give or take. Apologize, it's not too exact. I'll try to highlight it. Okay, so the white line represents the current price of 1 month options. We have an upcoming event. The question we're asking ourselves is, are those options prices too high? Well, it depends a little bit on what you're expecting, but think about the last 8 quarters, because that's what I'm capturing here. Every time the orange event landed above that line, you got a reasonable deal buying options at this price. That's a way to read it. And what we can actually see is that this quarter over here, good. This quarter over here, good. This quarter over here, fair, fair, good, and then poor. What will this quarter be? I don't know, but I would say that based on the recent history, it does not seem to me as if options are grossly overpriced going into earnings. That said, one way one can mitigate the issue if you do end up overpaying a little bit, as you would have done had you bought options going into the most recent reported quarter where we didn't get a whole lot of movement, is indeed by using a spread. So, the stock's higher today. I don't know. Actually, let's just pull that up again one more time because you didn't indicate whether you were. Let's take a look at this thing. How's this stock doing? I'm going to just populate the 150-day into here so we can get a look at that. I would like to have a year chart. It looks like we actually dropped below that level. It doesn't look like a wonderful chart to me. What are some of the other technical indicators giving us? So here what I'm going to do is I'm just going to pull up a table of about 32 technical indicators, and we're going to see how many of those are positive versus how many are negative. Wow, you don't see that too often. So we have 20 some odd indicators here. Buy and hold, we can ignore that because that's not a technical indicator. That's just a long-term investment strategy. 3 technical indicators are positive. All the remaining ones are negative. Shall we say put spread? I think that would probably be the way I would lean. Look, we have now seen a couple of names come out. Their results were not good, and a couple of stocks have had massive gaps lower. This one's already pretty hard hit. My 2 cents, just looking at that, that might be my approach. But yes, put spreads would be an excellent way to deal with the higher implied volatility. Everybody who watches this, who's seen it before, knows I'm not crazy about selling premium into events. Joe Kamen, audio breaking up. I just saw that. I'm going to ask the producer. The producer is telling me in my ear that it's not breaking up for him. So I'm not sure what that is, but it's on his radar now too. Okay, Bob, thoughts on Amazon August 16th long calls? I have the 180s, 85s, 90s, and 95s. A call strip. That's what we call that. Shall I exit or roll it out to November before the QE report tomorrow? We were just talking about, so QE is obviously not talking about quantitative easing, he's talking about quarterly earnings. We were talking about Amazon and Microsoft last week. These are some names that so we've got the results out of Microsoft, sold off, bounced back. Good growth, good numbers, technically hanging in there. Carter Worth spoke about this, and I'm just going to illustrate his observations, which You know, what am I doing? I actually have this thing saved, so I don't need to do it this way. This was the observation he was making. Long-term uptrend, it has bounced back to that uptrend from basically, what was that? Sorry? Somebody was that? Maximize, okay, yeah, thank you. So this is what we're looking at right in here. You'll notice that the stock has been in this prolonged uptrend since the back half of 2022, and it has essentially come down to and bounced off of this long-term trend line. That long-term trend line is essentially automatically being generated by the 150-day moving average, but if it's helpful for anybody who's curious, I'm just going to draw the line in here anyway, just to sort of make it that much clearer. So I'm just going to put in a trend line. We're basically right in here. So you can sort of see that's what we're looking at all the way down to here. I didn't quite line all those points up, but you get the idea. Fundamentally, the story is strong, great cash flow generation, great year-on-year growth. So these are all positives, and it's not my habit to suggest selling out of winners while they're still winning from an operational standpoint, as long as the technical story remains intact, which it does. The thing about call options, is that you are essentially provided with some measure of a hedge in the event that this does not play out. If you roll your options out, you are going to see some vol crash. Now, the 195s, what's the implied move here? I think you said you had the 195s among other things. So we're talking about a $10 move, a little over 5%. Yeah, I mean, I think that's fine. You're going to get a vol crush, so just be prepared for that, right? If you have short-dated options, the premium's going to come out after earnings are known. Oh, by the way, well, let's look at this. How much will that vol crush be? I think we've talked about this before. I'm not 100% sure, but this is something that I'm always interested in and that I frequently look at ahead of Catalyst, which is once I look for these events where you have earnings, which we're going to put in here, and then look to see how much vol fell after the fact. So I can do a quick calculation probably. Vol's actually just basically been on a steady downtrend here. That's 3-month vol. We're really more interested in 1-month vol because you own short dated. So you see these little gaps down. So obviously have an event in here. So every single time you see a sharp decline associated with some volatility, here, 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 and soon to be here. What you're dealing with is the vol crush that followed the event. And so we can see over here, it fell from 60 to 42, so 43-ish. Here it fell from 54 to 37-ish. 47 down to, you can see the trend, by the way, 31. 42 down to 28. That's a pretty, on a percentage basis, that's a pretty big decline. This one's even bigger. 48. So you're going to get a pretty big vol crush in those front month options. I don't think it can't even be as big as this one was because we're not as high now as it was then. But one thing to think about is, okay, where do I think, based on this, that vol is going to go? I think that this is probably about as low as it's going to get. I don't see any reason why Amazon vol is going to drop precipitously below that of the S&P, or more, probably more accurately, I would think about it in terms of the Qs, even though it's kind of a retail name. So what does that mean? You're probably going to see vol come down into this neighborhood here, which is about 25%. And another way to think about that is, if we take a look at one of those options, we can actually calculate on a standalone basis how much of an impact that's going to have on that options value. So So these are the August 16th. So we're gonna actually model that together here and now. All right. So I'm gonna go to the August 16th 185 calls or thereabouts at the money options. We're gonna take a look at these things together, and we're gonna say, okay, here we are. I'm going to full screen it. Yep, I'm with you. Okay, so here we are. Implied vol, this is on the ask, by the way, is 51. So if I take this down to, let's say 30, all right, so that's a $9.20 option. That call is the 185 call, which is $2 in the money. And maybe I should actually put the 190s in. Let's do that. It'll make things a little bit clearer because of that intrinsic value, clouds everything. Okay, so the 190s. So we're going to take that vol down. Is that really where that vol is? That can't be right. Hang on. Apologize for the short interruption as I click back here because I think that is not correct. That implied vol was suspect. Yeah, that was definitely wrong. Machine, the Bloomberg machine was telling me 60 vol. No, definitely not. 50. Okay, so we'll just take this down to 30. So this is a $6.70 per contract option. We're talking about the August 16th 190 calls, pre-earnings. If the stock doesn't move, what are these options going to be worth the next trading instant after earnings comes out, net of the vol crush? The vol crush could be 20 vol clicks. So that takes it down to $3.52 a contract. Okay? So that's a pretty big decline. We're talking about losing almost half of the option's value instantly. So that's just something for everybody to think about. This is one of the reasons why if I'm going to sell options premiums going into an event, which I will sometimes do, but if and only if I own it someplace else, and there I'm usually just trying to play for the vol crush itself. So what would I do? I might look to roll the options, the long side out, so that I capture not just earnings tomorrow, but the one on the 25th, which would probably mean I'm going to have to trade, let's just take a look. So that would mean I'd have to own the Novembers. Because all of these other options in the intervening period are going to see some vol crush. Although there is one mitigating factor, I mentioned this on the last live stream. The election volatility, September, October volatility is usually baked into the cake. There's some other events and catalysts that are not idiosyncratic to Amazon that are going to play in that can preserve some of that. But your August options are going to probably get hit pretty good in terms of extrinsic value. Use that how you will. Okay, so let's get to our next question. If I can find it wherever I put it. Here we are. Okay. Corey, my new rule, if at the upper range near tops and have significant profits like we had, put on the hedge for protection, especially when VIX is low and insurance is cheap. We went from 503 in the triple Q to 455. Yeah, good point. If you have a hedge on vols cheap, you haven't gotten the move. Remember, hedges, you have hedges for reasons, and you don't just get rid of them. How about that spicy barbecue tasty? How about that blow off top in the Russell 2000? He's using IWM. And actually, I had saved this chart, so I'm just going to pull this one up. But let's shorten this up a little. So this is interesting to me just in terms of what it tells me about the election. So as I had said before, I view this to be a little bit of a Trump trade thing. And it's being widely reported that Kamala is polling way better than Joe Biden was. And that my concern was for the Trump trade, that where he basically looked like he was going to walk through this upcoming election, that was less certain. My own judgment, take it for what you will. I'm not 100% sure that that's true. There was some big enthusiasm that immediately followed her essentially becoming the presumptive nominee, which I'm sure will be official in no time. What has started to happen, of course, and this would be expected under any circumstances, is that her opponents are busy trotting out what they view to be the current administration's policy failures, particularly those where she may have had a hand in it. And among those, of course, are issues associated with the border and immigration. And it doesn't seem to me that their denials that she was associated with the border are really resonating with the electorate. It seems a bit too earnest, and now her campaign has a new tack, which, by the way, in their defense, was Donald Trump's tack first. So Donald Trump was talking about Kamala being weird, and now Kamala's campaign is talking about J.D. Vance and Donald Trump being weird. Weird being a campaign, catchphrase or word is in itself rather weird. I find it rather weird that people from, say, Portland, Oregon, or Austin, Texas, where I used to live, which are towns that have the motto, keep Portland weird, keep Austin weird, places that skew heavily in favor of the Democrats are now using weird as a pejorative. It's a rather interesting campaign tack. But the short version that I would just offer in all of this is that there are a couple tells we have. So you can take a look at real-time betting, and I like to see how are people betting with their real money on the outcome of the election. That's probably a better sense of it. And how they're betting on the Russell 2000, in my view, is probably indicative as well of how real money is viewing the election. And so as long as the Russells bid, I kind of feel like that's a bet that was part of the Trump trade, and I kind of feel that is indicative that some equity investors are still favoring him to win the November election. Again, not telling you who to pull the lever for or mentioning what my own vote is going to be. Although not that one of these days maybe I can tell everybody how I voted in the past elections. It may surprise people on both sides of the aisle. I expect it probably would. But I've had the luxury of participating in elections in an area where regionally the outcome of the election was a foregone conclusion, which meant that I could, bet like a policy wonk instead of trying to actually swing the results of the election, which were unswingable where I live. They're unswingable in Marin County, California. They were unswingable in Travis County, Texas. So, yeah, there it is. Okay, so let's see what other questions we've got, if we have any, that we can take. Maybe the dog moved. She did, but only slightly. And I'm not going to encourage her to move anymore. Okay, Lamb-Weston trade. Is that trade still intact? So, this is an interesting one. And I have a feeling it's going to take a little while for this to play out. As Jim told us, because I made that bet on Lamb-Weston, and then he reached out to me over the weekend and said, you're bucking the trend. You're trying to basically swim upstream here. In my defense, I'm sure his flow is really helpful. You can look at the chart yourself. All right, so stock bottomed out third day, basically in, and it has traded a little bit higher since then. So going back 1, 2, 3, 4, is that 4 days? Let's see. What are we looking at? Stock's up 13%. Looks intact to me. And 13%, frankly, off of these valuations, ain't a big thing, right? So let's think about what I mean by that. Remember that when I mentioned Weston, and you take a look at their pre-big EPS growth story. So if I go back to, say, 2019 EPS, the stock was trading, by my work, something in the neighborhood of 12 times that much reduced number. 12 times, I think, they're the lower end of the company's own guidance, which, again, memory serves because I don't have it in front of me. 435, I believe, was the lower end of their guidance. Not hugely expensive, right? So if the stock goes up by 10%, if a company is trading 11, 12 times earnings, and the stock goes up by 10%, 13.2 times earnings, do you evacuate at that point? No. I mean, if a company is trading 30 times earnings and it goes up 10%, does that make a meaningful difference? Well, maybe, maybe not, but there's a multiplier effect. The company is still cheap. So to me, yes, it's still intact. Hope that helps on the Lamb Weston side. Thank you for being a subscriber, by the way. Okay. And Joseph says, do you suggest any options trades to profit from the elections this November? Well, the first thing is that I don't mind leaning into the Trump trade with a hedge, which, by the way, I should point this out, right? So let's just say you're not in that trade and you don't have the hedge on that we talked about previously. How does one do that? Let me just bring up the OptionPlay app real quick so I can just illustrate this. Another way to trade on the long side with a hedge, depending on, and look, how you decide to follow this trade is going to depend a little bit on your own perspective on who the potential victor might be, right? So we have seen that as Trump trends higher in the polls, that has generally been positive. We also saw when he won in 2016 that after an initial huge gap lower in the futures overnight, that the market just went on a tear, double-digit gains. Basically, just traded straight up. So this is, again, not a referendum on one candidate versus the other. I mean, we're just going to have to acknowledge, though, that I think most people would agree that Trump is going to be more business friendly. And equities are going to respond in kind. He's probably less likely to promote a big increase in something like corporate taxes. Biden was encouraging a steep increase in corporate income taxes. Microsoft just reported, and the numbers they came out with were better than $20 billion after tax. Paid about 5.2. Again, forgive me if my memory's a little bit off, but I read these things and I'm just telling you what I remember. I think their income tax payments were about $5.2 billion at whatever their effective corporate tax rate is now, which we can actually infer from the two numbers I just provided you. So they're paying 18 to 20% effectively in corporate income taxes. And I've seen proposals coming out of the Biden administration like, oh, it should be 40. Well, that has a really big impact. That would effectively mean that, instead of reporting $20+ billion in net income distributed or retained for shareholders, you're going to clip that by about $5 billion. That's meaningful, right? So, we have to acknowledge as investors that what goes on in Washington matters to the value of the businesses that we elect to invest in. Taxes are a big part of that. You could be in favor of them or you could not be in favor of them, but it matters. So if you're going to do this, you could trade to the long side, bearing in mind what those sensitivities are. Just reach out to December, maybe a little bit further, and You could go out to the end of the year or January, but just make sure you get past the election, or you could just choose November. It's fine. And buy calls in IWM. And my own preference would be probably to spread a little bit, because we've seen an uptick. So you could buy maybe a call spread, but I would probably use a diagonal. So sell SEP against long NOV, wait till it expires or essentially becomes worthless, and then just roll into it that way, just essentially offset some of the decay. My 2 cents for whatever they're worth. Maybe they're worth 2 cents, maybe not. Okay. All righty. I think we have indeed chewed up an entire hour. I want to thank all of you who tuned in today for joining, and I hope you found Jim's comments interesting. I think it's going to be even more interesting, and I hope to invite him back, and especially if we start doing these live streams in the middle of the day. What are you seeing right here and now? That's what I want to. That's really what I want to know. After the close, yeah. Oh, it's great to know what people were pressing the shorts on, but I'd like to know where the sell orders are ahead of time. That'd be nice. So maybe we'll try to get some more of those middle of the day live streams going, like we did earlier this week, and get Jim back as well. Thank you all very much for watching. Like, subscribe, tell your friends, and leave your comments, and we will try to address your questions in the next show, which is going to be on Monday at 4:15 Eastern. And we will, if you hit the notification bell, that way if we change the schedule last minute, you'll know. Thanks for watching.